Good afternoon and welcome to this update with myself, Jonas, Edholm, and David Harris. It's an interesting time to consider investing into a global small and mid-cap fund, especially if you're involved in value and contrarian investing, such as ourselves. These stocks are now trading at a very large discount to, for instance, large cap and mega caps globally, of course, especially in the US, but also on a global basis. So in this presentation, we will go through the portfolio, how we see the future shaping up for value investing in general, and also a couple of new investment cases. So to begin and just refresh your minds what we are up to in SKAGEN Focus, we have a focus on finding these undervalued, forgotten, perhaps misunderstood, completely ignored gems out there in global small and mid-cap equity markets. We also have an optionality to invest in large caps. We in exceptional situations, we currently have about 75% in small mid caps, and then we think about mid caps up to 10 billion US in market cap size. We look for deep discounts in global equity markets. We have a requirement of 50% upside in 2 to 3 years' time to our fair value price of any equity on a normalized or steady state earnings number. That means we don't take future potentially too optimistic predictions into account on earnings. Instead, we like to see these potential growth assumptions as a free optionality in our investment cases. So we like growth, but we don't like paying for growth. Instead, we look for these deep discounts to normalized or cyclical adjusted earnings power. And this often comes in combination with strong balance sheets in terms of big cash positions, net cash positions in companies, maybe cross holdings in Japanese small caps or mid caps, and also maybe real estate property assets in the company's balance sheet that may come to shareholders' pockets at some point in time. We also want to highlight we have a strong focus on green transition investing, finding the misunderstood and interesting ESG gems out there in these global small and mid-cap equity markets. So another thing with us, of course, and you may know this already, that we are very interested in going against the stream. We are contrarian investors, and that essentially means we're looking for stocks where perhaps few others are looking at a particular time or area of global equity markets. And this is possible through the fact that the investment herd moves very powerfully at all times, most often in the same direction, creating these full market highs or bubbles, even bubbles. You may argue that some of this AI speculation now currently is indeed reminiscent of a bubble. Or you have the herd leaving or ignoring or completely have completely wrong perceptions about one sector, one area, or one stock. And that's where the contrarian aspect comes in. That's where we are and trying to find these undervalued gems with this interesting 50% upside at least in 2 to 3 years time.
In essence, you could summarize our process with the help of 3 C's. The first one is for cheapness. So we always require a substantial discount to fair value for anything to qualify into the fund. We need to see at least an upside of 50% to our target. But we also, and this is as important as cheapness, we require to see change, to be able to identify catalysts that could support a re-rating, and we need to be able to believe that this can happen within a 2 to 3 year horizon. And then the last one for common sense. This is much a common sense based approach. We're quite conservative when it comes to valuation. We're very strict with our price targets, and we like to diversify among fundamental risk exposure factors as we build the portfolio together. And we also come from a context and a long tradition of contrarian value investing since the foundation of SKAGEN, which is now more than 30 years ago.
So how are we fared in terms of performance? Well, we like to share this chart with you, which is the development from the pandemic bottom, where we think there was a big reset in terms of market developments. And the markets were clearly not expecting an environment with higher inflation, higher interest rates, a war developing in Ukraine, Russia, also creating a commodity inflation on top of all this. What happens when you completely stop and then restart a global economy? That's an experiment which never had been, executed upon before. And we can now see these results. And as the investment map was turned basically upside down, SKAGEN Focus has been able to perform very well during this period, essentially outperforming the benchmark and also the value benchmark by a wide margin, as you can see, more than 50 percentage points over this period of time. On a 5-year basis, a little bit tougher environment for our fund versus these measures, especially the old country world index, since value had great headwinds in 2018 and 19, as it were back then. But we hope to build on this development as the environment doesn't look to be changing much in terms of interest rates and so on. Although we may have seen the top in interest rates, we think it will stabilize on a much higher level than prior cycle period.
If we zoom in a bit and take a look at performance this year, we're off to a good start. The fund is up almost 11% in euro. And if we take a look at some of our positive contributors to performance, we have at the top Panasonic, which is a Japanese conglomerate, which is going through a restructuring process to increase profitability, and where the market started to discover the potential that comes from their battery business, where they are the main supplier of Tesla, and where there's a huge expansion potential in the US that could become a strong earnings driver. We also had a strong performance coming from São Martinho, which is our Brazilian sugar and ethanol producer, and also among the positive contributors, ST Microelectronics, which really stands out as maybe one of the most cheapest semiconductor stocks globally, and where recently they have closed some of the valuation gap, which we have seen before among them and some of the US and Asian peers. On the weaker side, we have closed our position in Canfor Pulp, where they have reduced their production footprint in a difficult operating environment, and this also reduced their normalized earnings potential, so we have closed that position. And we also closed our smaller position that we had in Eramet, which was a small mining conglomerate. They have been under pressure due to lower commodity prices, but also we have noticed increased political risk in one of their operating domiciles. When it comes to Emart, which has been a negative contributor, we have increased our position. This is a South Korean consumer conglomerate, which has been struggling with weak performance, but we see very attractive risk reward here and a normalization potential in the short term. So we have added to that name. Also worth to highlight, we think since our last update that the team and the fund has received an award. We went to London to receive the Lipper Award for Best Global Small and Mid-Cap Fund over the 3-year category. It's of course very pleasant to see value managers being able to receive this type of awards, and also good and fun for the team, of course, to see a recognition of our process. And we have seen quite some interest lately as people are looking to add exposure towards value, but struggle to find teams which has been able to execute this process in such a consistent and price-driven way over time, as we have. Both me and Jonas has worked together for more than 10 years and seen some of the more tougher years for value, which has, of course, strengthened our process and team.
So if you think about SKAGEN Focus, you should think about deeper value, contrarian global small mid-cap investing. And we'd like to show you this chart, which essentially shows the development within growth assets globally and value assets globally since 1975. So a rather long perspective here. And you can see there's 2 periods here where value assets has been really struggling versus growth assets. The first period was highlighted in green here, was the IT bubble, of course, which lasted over a number of years, then followed by a very strong period for value or assets or more cheaply priced asset. Again, of course, the long period we can call QE or the emergence of big tech era lasting from 2010 maybe all the way up to 2021 was of course a long walk in the desert for us value investors, since higher multiples were completely ignored and stocks just got more expensive as the interest rates fell, of course, accumulating in the pandemic. But this is now reversed, and this is now sort of stabilizing, and we're now in a period where we think value assets have some real catching up to do versus these growth assets. And of course, you should think that SKAGEN Focus should do also much better than value in general, since we're a deeper value investor with an unconstrained mandate. So this is an interesting time to consider this type of exposure, we think. And also looking from sort of the bird's eye view in terms of where these equity markets stack up versus their historical multiples in terms of PE. And indeed, it's no coincidence that we have very little exposure to the US, since it's by far one of the most expensive equity markets out there. In fact, the earnings yield is on parity with the risk-free rate in the US currently, which is an interesting observation, we think. We have about 12% or so in the US in direct US assets. Also, we have exposure in Japan, and we have had for a number of years around 15 to 20%, and we're now beginning to harvest those returns, especially the Japanese banks. And we have added a few new investment cases, which we'll share with you. Also, European industrial seems to be trading very cheaply, as well as other select assets in primarily cyclical assets in the European equity markets, where we also have added some very interesting names, which we'll share with you.
I think any manager you meet would say that they want to buy low and sell high, regardless of investment style. But where we think we stand out here is the way we defined undervaluation, and that we always require an upside of at least 50% for anything to qualify into the fund, because we value companies based on their current assets and their normalized earnings potential, not really taking growth into account. So quite conservative approach, as we tried to mention before. It's also important to note that there's a wide spectrum in which we can do that. Everything from identifying a normalization of earnings potential to restructuring potential hidden value in the form of tangible assets, cross holdings or land assets, or different layers of discounts that we can find. What you see in front of you are just some examples from the portfolio. One company can, of course, tick more than one of these boxes. The more, the better. But let's take a look at some of the new additions that we made to the fund since our last update, starting in the US.
Yeah, although US might be one of the more expensive equity markets out there, we still find some interesting gems in this equity market too. And this is a spin-off from another company, and you probably never heard of it. There's about 250 companies that spun off each year globally, which is an interesting situation. And we like to call it the mother of all market inefficiencies, which means it's an asset which is not very well understood, not very well covered by analysts. In fact, zero coverage when it arrives to the shareholders' attention from getting it from the mother in a tax-free spin-off in the US as Disage. And in this case, we have Borg-Warner, which is an automotive part company in the US, spinning off assets into something called Finia. And Finia is the taker of the fuel injection system assets in Borg-Warner, related to mainly traditional engines for commercial vehicles and also for autos in general, leaving Borg-Warner with the electrical vehicle exposures. The first thing that this is clearly misunderstood, we think, because there are huge growth opportunities for Finia in hybrid vehicles, as well as in hydrogen-powered vehicles. Also, they have about a 50% exposure to commercial vehicles versus the personal vehicle space, which makes the process of converting into this EV much slower, prolonging the duration of the Finia's earnings powers, of course, in the traditional business. And this thing is priced as it's not going to go anywhere. It's priced as this stub will sort of disappear in 10 years or maybe or so, at about 3 times current earnings power. So it's an EBITDA of 500 million-ish on a $1.2 billion market cap. Very strong balance sheet. They recently launched a 150 million share buyback and also have initiated a yield before any analyst even cover this stock. And it's trading very cheaply because index pressures and selling from the investors that got this in the first place in the spin-off has now been selling off these assets, so it's trading at a huge discount to what we believe is a fair value. Our upside here is about 85% for Finia, from current levels to about $50. It's about 3% of SKAGEN Focus currently. Also, these spin-offs, we have been involved in many of these situations before. As I mentioned to you, we look at some of the 250 companies that get spun off every year, and sometimes there's a gem out there. And we, for instance, had a very good run in Accelleron, which is now sold at price target, spun off from ABB. We had still hold Vitesco, a powertrain EV producer, which was spun off from Continental, a good performer this year. And one of our absolutely best positions this year is Iveco, which was spun off several years ago from CNH Industrial, the truck company, the truck producing company, Iveco. So this is a very interesting area for us to cover in the fund as we look for these ignored, misunderstood, and not very well covered equities.
If we move over to Europe, where we see small and mid caps in particular trading at historically very attractive levels due to the macroeconomic environment, we have been able to add Signify to the fund. Signify is maybe more known to most of you for its brand Philips Light, and they are a global leader in lighting, benefiting from the transition that has been happening from conventional lighting to LED, where they have a very strong market position and very attractive margins. It's important to note that this is not only a consumer business, they have a very high exposure to professional clients, where they deliver everything from street lighting for entire cities to office buildings and industrial applications. This is now a 2% position in the fund. We think that the market is missing the underlying resilience and the cash flow here, the very attractive free cash flow potential, the strong balance sheet, and the fact that the company now trades at a significant discount. It trades for about 5 times its own cash flow generation right now, and it's backed by a solid dividend. So very attractive position, we think. And if we stay in Europe, we can take a look at another addition in the fund.
Yes, we know that AI has been a theme in equity markets, and we know that stocks like Nvidia and so on is trading at 20-25 times its own sales, not earnings, but sales. And is there a way for us to get exposure to this theme? Of course, we look, bottom up for equities that are mispriced, that are ignored, and we found Siltronic, in European, a German industrial company, essentially producing the cement for semiconductors in general, which are called wafers. They're one of 4 players global that do this, have about 25% market share, and delivering these wafers for all sorts of chips, for instance, Samsung, Hynix, TSMC, and so on, essentially also capitalizing on the trend in data centers and AI and so on, but of course also are exposed to the more traditional semiconductor production in cell phones and in computers and so on. But the difference here between these hype stock is this is trading at about 3 or 4 times its forward earnings power, with a very interesting balance sheet, and also trading at a cyclical low, as there's a cyclical pressure, there's a normalization angle to this investment story, as well as an expansion story as they're building a new plant in Singapore. Siltronic is about 70% upside, I think, to its price target, and it's about 2% in the fund currently.
Right, and then if we move over to Japan, which we mentioned as a very ignored part of the market, we think, where we have been quite active over the years and where we have seen much change, much happening. And that's one place in the market where we really think you can get paid for improving ESG, especially G, governance, and capital allocation. And if you dig deep below the radar, you can find things like Pasona. Pasona is active in the HR industry, helping companies to become more efficient and offering them outsource opportunities. If you look at the chart that you have in front of you, you see to the left the entire market cap of Pasona. So what you pay for Pasona in the market today. To the right, you see the market cap of Benefit One, another company in the same sector, where Pasona has a 51% ownership stake. So here it becomes start to become really absurd if you just see the relationship between the value of the stake that they own and their own market cap. But absurdity doesn't stop there. Then you see the net cash position in relation to their own market cap. So on their balance sheet, they have a net cash position, which is quite massive. And on top of this, Pasona has a own profitable core operation, which the market completely ignores. So there's quite a significant upside to the theoretical asset value here, as you can see. And in terms of change, we have identified the rising level of activists that has been coming to Japan, becoming more vocal over the years. And we also have seen activist involvement in Pasona, which we think over time can drive change here. So a 2% position in the fund currently, Pasona.
And also want to highlight that we, as we have indicated in other updates to you, that we have been active in Japan and specifically in Japan financials and Japanese regional banks, where we have held a number of assets. And currently we hold Keio Bank, which is a smaller regional bank in that prefecture, and also Shiga Bank, which is a somewhat larger bank in Japan. And also Japan Post Holdings, which essentially is the postal office network in Japan, but also holding vast stakes in Japan Post Insurance and Japan Post Bank and other assets in there. It's essentially a conglomerate. These stocks have been very strong this year. They're up, I think Keio and Shiga Bank is up 40 or 50% this year. Due to a number of reasons, people are really discovering, or the general investor is discovering, the discount in Japan. When we initiated in Shiga Bank, for instance, the stock was trading at 25% of its liquidation value. That's pretty absurd to begin with. Now you're getting the EPS momentum, the earnings momentum potentially coming in through a higher rate environment in Japan, which will drive, of course, net interest margin and so on in these financials, essentially creating increasing profits for the first time in many decades, as in combination with very strong asset quality. We have now started to reduce some of these exposures since they're at price target, but we still find the theme interesting. And Japan Post Holdings now our largest position, currently at about 4.5% or so of the fund.
Yes, and then maybe just to share some takeaways from our recent research trips. We recently came back from a trip to West Africa, and there are certain moments in life when you feel that you are far away from home, and this was definitely one of those. West Africa, as many of you know, offers some of the most attractive gold deposits on the planet in terms of high grade and scale potential, but this jurisdiction, of course, comes with higher geopolitical risk. So it's important for us to understand as these exposures can differ quite a lot. We went down to Abidjan in Ivory Coast, where we visited, among others, Fortuna Silver, its new deposit Seguela. Fortuna is a 2% position in the fund currently, and Seguela is now one of 5 assets that they have globally. Seguela recently ramped up to production on both time and budget, so that was quite impressive. And Seguela is a very impressive asset due to its high grade, large-scale deposit, but also expansion potential, which bodes quite well for this to become a corner asset in the company. It has a very high margin. If you look at the cash cost per ounce, it's approximately half of where the gold price is today, so the margin is very attractive. And the asset is estimated to be break even already within 2 years, and then be able to fund both growth and significant capital return over the years to come. It's of course very valuable for us to be able to make trips like this and meet people. Some of the best people in the world globally in this industry who decide to move from one part of the world into almost the middle of nowhere, to spend a few years there, to see what they see and what drives and motivates them, but also to see the type of impact a company like Fortuna can have on the local population there, and what their presence can mean in this region, and possibilities for the surrounding villages, of course. So very interesting trip where we learned a lot.
Yeah, we have another postcard for you. It's from US, Virginia, Richmond, where we also visited Cascades, which is one of our holdings' new plants. It's called Bear Island, which is one of the most modern containerboard plants in the world, which essentially will increase the production for Cascades containerboard business by about 30%. It's already started producing. And this is a case that's been in the fund for almost 2.5 years. It hasn't really delivered for us due to a number of reasons. For instance, higher input costs. You have had issues on supply chain, logistics, and so on. But now these pieces maybe start falling into place as the spread between containerboard prices and OCC, the main input cost, the recycled material to make these boxes. This is a completely circular operation, by the way. So it's a great ESG company from that perspective. It's really on a record level, these spreads, and also at the same time they're getting their tissue business in order by closing down plants and restructuring. So we think there's a good potential for this company to produce a very interesting free cash flow yield and also delever their balance sheet. We see the free cash flow potential being almost 20% going forward on this quite low market cap as they have currently in Cascades. So this is one of the stronger positions for this year, but we believe there's still plenty of upside in Cascades from here, and have a 2.5 position in the name in this Canadian packaging company currently.
So just to summarize some of the major portfolio adjustments that we have made since our last update, we have covered most of them. We've added Finja, top 10 position in the fund. We also added regional US bank First Horizon, which we covered in one of our monthly letters. We had no exposure to US banks during the turmoil in the beginning of the year, but on better visibility and quite attractive entry points have added to our exposure there during the summer. We have increased our positions and some of the names we have mentioned for you already today, and we have closed our position in Eramet, but also Endeavour Mining, which has not reached our price target. We closed the position in the money. It has delivered several of its catalysts, but we picked up on some new information during our research trip in West Africa that made us question parts of our long-term thesis. So we closed that position, and we also closed our position in Compo Group, where we have some hesitations with regards to their upcoming catalysts. So we see better risk reward elsewhere. We have been taking profit in the Japanese banks, Shiga, Keio Bank, and also trimmed our position in US food retailer Albertson, which is starting to trade closer to the bid price, which it has from Kroger.
Yeah, so taking a look at the top 10 positions, we currently have 47 positions in the fund. 75% is small and mid-cap positions. As we have described for you, we have a number of large caps as well in the fund with exceptional value propositions. We have 60% plus upside to our weighted price targets in the fund currently, and we work hard to keep that number high. That's why we have this, perhaps more higher than average activity in the fund, to be very active around our price targets and not holding assets which are trading above our fair value estimate. We sell then and pick a new stock with a new fresh 50% plus upside. And you'll see that the valuation is much lower than the benchmark, of course, at just shy of 1 time price book, and also a 10 times price earnings multiple across the portfolio. And we have mentioned some of these holdings, like Japan Post Holdings being the largest position in the fund currently. Finja we discussed. We also have increased our positions in some of these other names. Danahos has gone higher due to its own performance, which is a container ship operator, which has managed to lock in very nice earnings power over the next few years and look to be earning its own market cap in less than 2 years here So that's an interesting value case for us, as well as Albertsons, which we have somewhat reduced as it's trading, as David mentioned, closer to its bid level from Kroger. So just to sum up what we have discussed today, we think we are in position to deliver very interesting returns, and especially interesting from a timing perspective now, as small and mid caps are trading cheaply to large caps, and especially small mid cap value is trading exceptionally cheap versus large and mega caps. And we have indeed delivered a strong performance over the last 3.5 years and have a very decent upside to our current price targets. So I think we can stop there for now, and thank you for your attention.